I'm Herbert Okello, a valuer at Knight Frank, Uganda, with over 7 years working experience within the valuation and advisory department. Knight Frank provides a wide range of valuation and advisory services across the commercial and residential sectors. So whether you're a client who is interested in concluding a transaction on property, or you're looking to secure a mortgage with property as collateral, or you're even looking to report the value of your assets within your financial statements, then our dedicated team is able to provide a timely and professional advice. And we also have the ability to draw on a global network of over 19,000 people to make sure that the needs of our clients are covered. A number of factors play a role in changes in property values. We are talking about demand, supply, prevailing prices, as well as rents. For investment property, such as offices, we saw a slight reduction in occupancy levels, which meant more supply of office space on the market with not as high demand, and that of course occasioned a reduction in rentals in grade A offices, so a 7% reduction in rentals, and that did impact the values, albeit slightly. We saw a similar trend in the prime residential sector, where we also witnessed a reduction in transaction volumes, and that was an indicator of a weak demand. And of course, when demand is weak, you don't expect prices to go up. Prices remain stable, and so did the values. And then the retail sector, I have to say, is a really resilient sector because occupancy levels remained fairly stable at 85%, and that was because of the steps that were taken to shore up businesses during that very difficult time. But of course, like other sectors, the retail sector wasn't spared of the effects of the pandemic. We saw reduced demand, and of course when demand is not as high, you expect vacant spaces to take fairly long to market, and also rentals were affected. So the values were also affected, albeit slightly. The COVID-19 pandemic presented unprecedented set of circumstances. Reduction in transaction volumes meant that there was limited reliable comparable information on which we could base our judgments on, and that's where the Royal Institution of Chartered Surveyors came in to advise RICS regulated members to include a material valuation uncertainty clause. And the essence of this clause was, one, to ensure transparency with clients, but also emphasize the importance of the valuation date. And this was in recognition of the fact that market conditions could change and rapidly depending on control of the pandemic or even future spread of COVID-19. At the time, we're also advising clients to keep valuations under regular review. The pandemic did affect the way we do our work, right from inspection to the availability of reliable, comparable information on which to base our judgments on. So it is only prudent that we are transparent and professional in the way we do our work. Where there is a limitation on information or even investigations have been affected, it is only right that this is reported. But also when valuation relies on information such as rentals, it is good to ensure the information is accurate but also up to date, and it is very imperative to keep such information confidential. The pandemic affected businesses, especially when you talk about revenues, but also the ability to service loans. And that's where the central bank came in to provide guidelines, one on credit relief and also loan restructuring. Loan restructuring was essential to ensure business continuity, but also mitigate default. And the increase in commercial valuation instructions was because of loan restructuring, but also we have a number of clients toward the end of the year who usually instruct us to provide valuations for purposes of financial reporting. So the increase in commercial valuation instructions was for those two reasons: loan restructuring and also end of year valuations for financial reporting. The recovery of the real estate sector is expected to be gradual, and this will be influenced by a number of factors, importantly, the rate at which the economy rebounds. When you think about the retail part of real estate, and here we are speaking about shopping centers, they do thrive a lot on footfall, and when you have restrictions such as curfew, this does affect the ability to achieve the high footfall which can ensure that they perform so well. So the longer you have such restrictions, then this will certainly impact shopping centers. And I have to say that vaccine rollout was a very big step in helping us to come out of this situation, but the speed at which those vaccines are administered will determine the rate at which the real estate sector recovers.